Live from New York City for our audience worldwide, Bloomberg's The Fed Decides starts right now.
This is a special edition of Bloomberg Surveillance with Jon Ferro, Lisa Abramowicz, and Tom Keene. Bloomberg Surveillance, The Fed Decides.
Live from New York City this afternoon. Good afternoon, good afternoon. Your afternoon starts right now. And that rate decision is 27 minutes away. After that, four of the biggest companies on the planet reporting earnings. And this is how the stage is set. Let's kick it off with the cross-asset price action and start with crude. Crude taking out the closing high of the year so far, just in the last few hours. Brent crude, 118 on an 8-day winning streak. Over that period, higher by more than 26% and up another 6% so far. Check out the bond market. This is the read-through. Crude up, yields higher. 390 on 2s, 440 on 10s. New highs for the year on 30s if we close at these levels, 498. Some think something's out of whack. We've got new highs on crude, close to new highs on yields, and equities still 13%, 12 to 13% off the lows. Equities this afternoon, just down 0.2%.
And it all hinges on what we get after the bell, which is the earnings from the likes of Meta, Microsoft, Google, and Amazon. Do they justify the enthusiasm for AI? And can it overwhelm some of the concern about a stagflationary shock that's coming to fruition? And that ultimately is what the Fed will be discussing.
I get that almost distant. I mean, it's there and it's really important and we're all glued to it. And I've had a lot of research notes in this morning. And John, this is the economist Michael Tyson with Everlast. Everyone has a plan till they get punched in the mouth. And your data check, which is wonderful, is that the new punch in the mouth where things become a bit unraveled?
We're taking a beating at the moment, but not in the stock market. That's what's interesting about this setup at the moment, Bramo. Insulated by the earnings story so far. And the earnings story so far, coupled with the economic data, so far, so good.
This sets up the real tension for a Federal Reserve that has to decide whether or not the strength in the economy can allow the inflation from oil prices, from the supply shocks, to ultimately transmit through the economy and become a more prolonged shock. This sets up the tension because ultimately, can you have your cake and eat it too? Can you have a resilient equity market that also allows consumers to keep on spending while absorbing some of these higher prices?
We're going to get started with the show, but I would just suggest, John, what's so important
show
here.
Started,
I mean, get to the guests and all that.
Okay.
We got Bob Michael on deck. But what I would say that's just so important, John, is you look at the moment we're in right now. What does Powell do? Just softball it through the press conference?
With great difficulty.
He's got to step up and make a statement.
There is some suspicion, and I think this is the question going into this decision, the statement and the news conference, whether they introduce a more symmetrical reaction function, or at least try and articulate one to anchor inflation expectations with the price pressure that's brewing in the commodity market.
Some people are saying ultimately they have to say the next move could be a hike or potentially some sort of cut. And could that change the market reaction? I'm not going to answer. Much better people are going to answer than that. Coming up shortly, JP Morgan's Bob Michael, SocGen's Subhadra Rajappa, and Deutsche Bank's Matthew Lazzetti. They'll be taking us up to that Fed rate decision at 2 p.m. Eastern. Then immediate reaction from Stephanie Roth of Wolfe Research and Citigroup's Kate Moore. And finally, breaking down Chair Powell's news conference, which I'm sure will be completely a snoozeville, Jim Bianco of Bianco Research and BlackRock's Jeff Rosenberg. It will not be a snoozeville. That will be where all the fireworks are, John, and we all are waiting to see what that looks like.
Looking forward to it. With us around the table, Bob Michael of JP Morgan. Bob, good afternoon. Good to see you.
Happy to be here.
Is it a problem that we're talking about none of that going into this decision? We're only talking about the future of the chairman of the Federal Reserve.
I think that's one of the big elements of this meeting. Is he going to stay? Is he going to go? There's certainly an exit ramp for him. The Department of Justice has dropped its investigation. He already called the Inspector General that reports to the Fed, by the way, to start its own investigation. If he wants to leave, he can.
Are you more interested in that, or are you more interested in this question of how they really portray a reaction function at a time where inflationary risks are back on the table?
So that's one of the three things we're looking for. The first thing we're looking for is how they characterize the economy, the labor market, and inflation, given all the uncertainty in the Middle East. Changing a word here or there, inflation remains somewhat elevated to just elevated can tell us a lot. The second thing we're looking for is exactly what you said. It's also in the FOMC statement. Look at the third paragraph. If they change the sentence that talks about the changes in additional adjustments to their policy range and drop additional that tells you they're migrating to something that's more symmetrical. And of course, the third was what happens to Powell.
Bank credit analyst up in Montreal had a beautiful note the other day that said, look, there's a reset here in inflation, which means all in all, we're more restrictive. This meeting versus the last meeting, $119 oil, the 30-year bond, 4.98% rounded up. Are we in a more restrictive space for Americans?
I think so. I think what we're looking at is cost push inflation. So it's behaving as a tax right now. When you've got gas that's probably over $4.20 a gallon on average, that's going to eat into discretionary income. So it will slow things down. What we have to watch is, does it pass through to core prices?
Yeah. What's great about this is cost push inflation, John. That was the last time people wore thin ties.
Oh,
That's
are you taking a dig at me?
No, not a dig at you.
Are
but
you saying this
cost
is
pushes from the 60s?
Are you saying I'm a choiceful consumer and can't afford a wider tie?
No.
Is that
I'm
where this is
saying
going?
you're fashion forward.
Or
Okay.
fashion backward, compared to what you're talking
Why
about.
am I the
cost
target of
push.
criticism? We're only 8 minutes into the programme. Give me a break. Can we move on? What if you wear bow ties? What decade are you in?
This is $119 panic green.
This is what happened after the Depression.
Yeah.
Yeah.
All
okay.
right, guys. Wow.
Well, we're exchanging.
Oh, yeah.
You want to talk
Lovely.
about markets?
Yeah, I do actually.
Let's talk about that. Let's
Thank
talk
you.
about inflation pressure. Bob, the pushback we get to the inflation review is the labour market simply isn't tight enough to worry about broad-based price pressure. Would you go along with that?
No, I wouldn't. Unemployment's in the low 4s. To me, that looks like a reasonable level for full employment before COVID. Let's see how the Fed characterizes that. And if you look at wage growth, it's going up pretty nicely. I think what we are seeing is inflation starting to pass through the system. Whether that will hit aggregate final demand, we have yet to see. But I think right now the economy looks in pretty good shape, can absorb some level of inflation for the foreseeable future.
This feels different to me from the last time we've spoken to you, or the last couple of times we've spoken to you. And you said you see this more as something more that causes demand destruction than, say, inflation. And you're all in on bonds, right? The idea that there definitely is an opportunity here. Can you describe what's shifted for you in terms of your expectation for inflation and how that kind of bleeds into your call?
Yeah, I didn't think we'd be here 6 weeks later with the Strait of Hormuz still blocked. I thought we would be in the end game. We'd talk about it reopening, there would be moderation in oil prices and take some pressure off of inflation. It seems like we're more in the middle of it still. So does that mean it goes on for another 6 weeks to 2 months? It could do. And then you're stuck with energy prices that are higher. You're stuck with gas prices that are over $4 a gallon, and you're forcing businesses to make a decision. How long do they absorb those costs versus trying to push them on? You will see some demand destruction, but remember, this time last year, we thought tariffs would create a lot of demand destruction. It did initially, but then the economy picked up again without missing a beat. So I'm reluctant to say this time the economy will stumble. It didn't last year. It might actually absorb that this year.
What's the unexpected you worry about?
The unexpected is that things spiral out of control. You do have $150 oil per barrel. That starts to push through and create a lot of demand destruction. And then the Fed's in a very uncomfortable spot. You've got very high headline inflation, but you've got an economy that's about to tip into recession. They have to decide which decision they make. Right now, we're talking about they could just remain on hold through year end and see how things play out. But a material spike higher would create a lot of problems.
Do you think we're really close to that tipping point right now?
I don't think so. It feels a little different than actually a couple months ago. It feels as though there are workarounds that are going on. We know there's an east-west pipeline. The 80% of oil that doesn't pass through the Strait of Hormuz probably could increase capacity. We're already seeing the UAE talking about leaving OPEC. I don't think we'll get there, but you certainly can't take it off the table.
Bob, it's good to see you. You're going to stick
Happy
with
to
us.
be here.
Bob Michael of JP Morgan Asset Management. This equity market wanted to move on. And to be fair, even this afternoon with crude close to 120, this market's not really responding to it.
Yeah, although what Bob was talking about there is really interesting. Is the stock market's sort of placating feature that the economy can look forward actually be a real negative for the bond market that the bond market hasn't woken up to? And maybe that's what we're seeing in the bond market, just waking up a little bit over time.
Looking forward to this. The decision about 18 minutes away. 30 minutes later, a news conference with Chairman Powell. Feeling a little self-conscious now, TK.
No, you look great. You're
I think it
styling.
looks fabulous.
You know, I'm delicate in the afternoons.
Well, you're styling.
You've got to look after each other, build each other's confidence, not
Fashion
knock
forward.
each other down.
I haven't changed my look for
Come
40
on.
years.
And you guys look fabulous.
Maybe after the commercial break, we'll swap.
Oh, that,
Please. I will pay good money.
Not a chance. Not enough. Not enough. Up next, Subhadra Rajappa, Matt Lazzetti.
I think it's going to be very hard for the Fed to do anything right now.
The Fed is boxed in here.
The Fed is going to sit on the sidelines. The Fed is just content to hold where they are.
On hold. On hold.
On hold.
On hold.
We're in a wait-and-see mode for the Fed.
Wait and see as long as possible.
There's a case for the next move is a rate cut, but it's really hard to say that should be happening right now.
You want to make sure that that door is slightly open.
It's unlikely that the data is going to be that clear moving forward.
I doubt that this Fed is going to be cutting into that.
There's plenty of officials who are worried about, the stickiness of inflation.
We have not seen this kind of political angst around a transition of leadership.
Jay Powell will stay at the Federal Reserve for some period of time.
Powell is going to stay on for a period of some months as a regular governor.
What we're going to hear from Powell is uncertainty.
He wants to come out of today, I think, with no market move.
Priya Misra of JP Morgan at the end there. That decision 15 minutes away. The price action, the scores, they look like this. The S&P 500 doing virtually nothing. This looks like a snooze fest. We're down only 0.2%. It is anything but right now. Check out crude. Up for an 8th consecutive session, the longest daily winning streak going back to May 2022. Up by 7% this afternoon, approaching 120. And this move in the bond market. Check out the front end of the yield curve. Twos right now. 391, up 7 basis points on the session. Go back to the day when the Fed last met, March 18th. That morning, 368. That afternoon, 377. We're higher now than we were then.
The thing that's changed is the length of time that this has gone on. And now the question is this a Fed that can cut rates at all this year? Right now, we're seeing a 25% chance baked into the market.
I went back early this morning before you guys got in, and I looked at the 30-year bond yield, and above 5%, I think it was 22, it was 7 days. So you think that's funny, huh? 7 trading days, John, 7 days. And the real risk here to our esteemed guests is, do we see a more persistent 5-year yield?
TK, just for the record, I'm sat here from about 5 a.m. Eastern time. Got Bramo here, and just behind Bramo, I can see the elevator that everyone coming down needs to go down. TK appears at about, I would say, 6:53.
Oh, yeah, I would say that's a little early.
6:53, and walks past the radio studio before even going into it. So
Yeah,
just to set the stage for who gets here first in the morning. I'm getting more feedback now about you and I doing a tie swap than anything else.
I'm glad that's important stuff.
Joining us now to discuss, not that, more important things, Subhadra Rajappa of SocGen. Subhadra, welcome to the programme. What are you expecting to see in 13 minutes' time?
Hopefully no fireworks. I mean, I think that we'll be looking to see what the changes are to the statement. And at the press conference, I'll be listening to Powell and see if risks are a little bit more two-sided as opposed to, I would say for a good portion of this year, the expectation was that the Fed would deliver cuts later on this year. So, the price action in the bond market's been very, very interesting, as you've been talking about. I mean, 2-year yields are close to 390, maybe headed towards 4%. But what's happening globally to global bond yields is even more interesting to me. So I think what might overshadow the Fed today is the ECB meeting tomorrow, and whether they sound hawkish and there's more potential for them to hike maybe 2 or 3 times this year.
Subhadra, before we get to tomorrow, there's a long road ahead of us, not only the Fed press conference, but also earnings in the United States. Do you think that anyone would care in markets if this Fed moved to a two-sided risk type of signaling, given the fact that the leadership at the top of the Fed is likely to change to someone who's going to be getting an earful from the White House?
And I think that that's really been the bias of the market, is that when Kevin Walsh becomes the chair, the Fed would sound somewhat dovish, and in fact potentially deliver a couple of cuts this year. But I mean, that is yet to be seen. I think that I still think that the bar for the Fed to hike rates is still relatively high. But we'll be looking for the nuance in the statement because it's still a committee decision ultimately. And if we do see a persistence of this conflict over a much more extended period of time than what the market's prepared for, and this actually leads to much higher realized inflation, then the Fed will definitely be in a very tight spot.
Bob Michael, what happens if we do get a persistent higher yield? To pick on the old benchmark to 30, if we get a persistent 5 or even 5.1% for more than 7 trading days?
I think then you have to start to think about what is the Fed going to do. And if the Fed is going to validate that move higher by switching first to a more symmetrical policy stance and then start building in rate hikes, perhaps at the end of this year or early next year, then yeah, you're going to see rates drift higher and stay there. But if they remain more balanced to the downside and thinking about this is transitory, we'll get through it, that will offer us a chance to bring rates down, and the dots don't change in the June meeting, then I think you'll see rates start to settle back down.
But let's say they go with a more symmetrical reaction function. This is what I'm interested in from your perspective. You're in the market. Would you believe them, or would you fade that move? Is that just a communication exercise, or does that display any real intent?
I would 110% believe them. I think it's an enormous policy shift from where they've been over the last 9 months. I think they choose every word carefully. They would sit there and deliberate. They also know that at some point, Jay Powell is going to leave. So do you change something that important right as Kevin Warsh is about to step in? So yeah, I would imagine that they're concerned about.
I have no doubt that the market would react to that move. But Subhadra, from your perspective, is it a move that you would fade? A move that you would take the other side of?
It'll be tempting to kind of look at that and say, you know what, maybe if 2-year yields start getting meaningfully above 4%, that might be a buying opportunity. I don't know if that's necessarily a fade. You do get a good opportunity to be long the front end under those circumstances, because ultimately the expectation is that the bias of the committee will be somewhat dovish, and this could be a high yield to lock into. I think going back to the Fed stance, the U.S. is in a very good position overall, and we're energy independent. Yes, the higher oil prices are going to hit the consumer, but for the most part, I think the economy is in a very strong trajectory. So I just don't see any need for the Fed to really change its bias or react in a meaningful way. So to me, that signals a buying opportunity in the front end.
Elisa, this is a central question to a key part of the yield curve right now. Does the 2-year have any business trading above where Fed funds is at the moment?
Ultimately, if this inflation does remain sticky and people can look through it, absolutely, because then you have to imagine that a rate hike is in the picture. And to your point about do you sell anything, do you not believe them? Well, sure. If everybody does that, then they don't get the tightening that they want, and then they got to go even harder. So it's sort of this is lots of fun.
It just feels like a communication exercise at the moment. Still feels like, from my perspective, listening to Fed officials right now, that the bar to actually hike is still extremely high. Now, maybe that changes with guidance, and you'd have to respect that guidance in the next 60 minutes. But certainly the way they've set things up with their own communication into this particular decision, it still feels like the bar is pretty high.
This is the reason why the dollar has underperformed places like Europe, even though you look at the U.S. economy and it's outperforming, because people believe that Europe will hike rates, and in the U.S. they won't, even at the expense potentially of inflation running a little bit higher for longer.
All of that can change in the next 10 minutes, the next 60 minutes, the next 90. Matt Lazzetti of Deutsche Bank joins us now for more. Matt, in your opinion, let's go through what you expect to see. Is this a Federal Reserve that's willing to drop its easing bias, given that crude is back close to 120?
Yeah, I mean, that is the central question for 10 minutes from now when we get the FOMC statement. I think that there's strong fundamental reasons that they should potentially adopt a more balanced language. The economy is looking pretty resilient. We got very strong CapEx data out this morning. Labor market looks more solid. Downside risks have been diminished. Inflation's at 3% on core PCE for the 5th or 6th straight year. And we think they're essentially at neutral. And so I think that there should be a discussion about a more balanced outlook. At the same time, I think strategically they are unlikely to adopt that in 10 minutes' time. In part, there's a lot of uncertainty. They don't want to change the communication language today, only have to unravel that at the June FOMC meeting. They probably don't gain much from going two-sided given market pricing at this point in time. And finally, just ahead of a turnover in Fed leadership, I think they might want to allow for Kevin Warsh to kind of give his view on what that communication should look like. And so I think fundamentally we should be having that conversation, but I'm not sure the Fed adopts it today.
Matt, what's the liability for this Fed if they don't adopt that kind of messaging, this sort of symmetric risk type of approach, given the fact that the market seems to be somewhat subdued on inflation expectations? If you look at the five-year forward break-evens, are there any signs that the market is pushing back on a Federal Reserve they perceive to be overly dovish if they maintain a cutting bias?
No, I think that's exactly the point, that they're at the moment, it doesn't look like they're at any meaningful risk of, if they don't send a materially hawkish signal, that inflation expectations will pick up materially, or that you might see financial conditions ease in a way that they might not like. I think that they're probably happy with where market pricing is for the Fed this year. Forward-looking measures of break-even inflation rates or inflation swaps are relatively subdued. So at the moment, it looks like a relatively low-cost choice for them to not adopt that language at this point, when there is the potential cost that, given the uncertainty that we have today, you have to undo that communications change at the June FOMC meeting. And I think that the Fed just likes to avoid those types of outcomes where they have to quickly flip on their own communications.
And Matt, speaking of forward-looking, what if the dots go away? How blind will you be at Deutsche Bank if Chairman Warsh does away with the dots?
Yeah, part of me would not mind seeing the dots go away. I think having to think about those in great detail every quarter as we look ahead. I think many Fed officials might agree with that as well. I think that there's times where they view the dots as constraining their potential reaction function in the near term. No doubt when you set the September dot, it does seem to back them into a corner a little bit for that December outcome. But I don't think they completely go away. I think more likely they change in a way that reduces their forward guidance signal. Potentially they talk more about central tendencies, that they go on a rolling window. The dots stay, but their influence is reduced.
John, should we medicate Bob Michael? He seems like
he
he's
didn't seem too happy, did he?
Chair.
As soon as you were asking that question and Matt started to answer it, Bob Michael just shaking his head. Yeah. You disapprove?
Yeah, Matt Lizzetti. Has a day in your career ever gone by where you haven't had to render opinion on the direction of rates? Have you gone 10 minutes into a conversation where somebody hasn't said, well, where do you think rates are going? I have about a dozen meetings a day, and everyone expects you to have a view on rates. Here is the body that sets the cornerstone for rates, and they're telling us they're not going to give any guidance because it's too difficult. Nonsense. I think they should do dots every meeting. They should put it out there. We're expected to have a view on rates. They're set the cost of money in the system. It's crazy that they're going to drop forward guidance. Okay, I've said my piece.
I agree with Bob there, but as somebody that has to identify each individual dot, I wouldn't mind if they reduce the emphasis on this a little bit. Completely agree with Bob. I think that there's some views that they might drop them completely. I do not think that happens. At the same time, I think that the Fed is overly worried about the precision around the dots and the focus on the median dot in an inappropriate way. And I think there are just some things that they can do to keep the broad guidance, but to downplay the precision of that forward guidance, perhaps by focusing on the central tendencies.
So, Matt, just to weigh in, just tell us a little bit more. How's that going to change, do you anticipate? How should it change? Just show the median dot, not show the dispersion?
So I think when you look at the SEP when it was originally introduced, it did not have even the medians. It had the central tendencies and the ranges. And I think, that is probably an outcome that Kevin Warsh prefers, which is that, I think last week he noted that on inflation, he doesn't look at anything to the right of the decimal point. And so I think he wants to reduce the emphasis and the over-precision that you see within the Fed, forward guidance, which might be precise and can become counterproductive. And so I don't know that they lose all that much by doing away with the dot plot and a specific median that everybody focuses on, and simply to say, look, this is where we think the direction of travel is for rates over time. We're not going to tell you exactly where we think rates are going to be, and we think people focus too much on the medians. But here is, broadly speaking, where we think rates could go over the next 2 years.
Bob Michael's not done, by the way. Forgive me for jumping in, Bob. Please carry on.
Go to a trim mean, on the dots.
Okay.
There you go.
That's the direction
Give
of
the
travel.
trim mean and the high and the low of the trimming.
Matt, it's good to see you. Matt Lazzetti alongside Sabaja Rajappa counting down to this Fed decision. That Fed decision is about 90 seconds away.
I am there for all of the dot passion this morning or evening or wherever we are right now. All I can say is this is definitely a clear thing that we can analyze and discuss, which at least is positive for us. So for us, it's fodder, as well as for analysts who also can point to that.
Quickly to Bob Michael's point, Robert Kaplan, ex-Dallas at Goldman Sachs, was brilliant on this today, taking the victory lap for Dallas on trim mean. But the research out of Kansas City, and particularly out of Cleveland, on what do you do with inflation to take out the excesses, and then that wandered down to Dallas, and that's what Powell and Michael are talking about, the importance of that trim mean.
Reminds me of that hearing with Kevin Walsh in the last week or so, and I think this will be an important question in the news conference later on this afternoon. Inflation's a choice. That was a pretty powerful statement from an incoming Fed chair. Inflation is a choice, and I wonder how the current Fed chair might respond to a question on that later on.
Well, are you saying we choose the inflation to be high, or are you saying we're choosing which metric to look at to decide about inflation? Because those are two different things.
I thought what King Charles said in his speech yesterday about inflation was really poignant.
You really love the
I'm sure
Royals,
you hung on every minute.
You really love the Royals, don't you?
I do.
Yeah.
I thought it was really quite
We're
good.
not talking about King Charles in this program.
He mentioned inflation.
This is a royal-free zone, OK?
Sort of.
Let's turn to the price action. Got a king around the table, don't we? OK, decision, seconds away. Equities negative by 1/10% on the S&P 500. Bond yields elevated, crude elevated. Mike McKee has your decision.
No change in rates, but we have four dissents. Lori Logan, Beth Hammock, Neil Kashkari agreed rates should stay on hold, but they did not support including an easing bias in the statement at this time. Stephen Myron wanted a quarter-point cut. The last time there were four dissents, October 6th of 1992. As for that easing bias, the statement still contains the phrase, in considering the extent and timing of additional adjustments to the target range, a line meant to suggest that the easing cycle has not necessarily ended. The Iran war figures prominently in the economic overview. Inflation is elevated, in part reflecting the recent increase in global energy prices, the statement says. Developments in the Middle East are contributing to a high level of uncertainty about the economic outlook. The committee remains attentive to the risks on both sides of its dual mandate, it says, even though recent indicators suggest that economic activity has been expanding at a solid pace. Job gains have remained low on average, the statement says, and the unemployment rate has been little changed in recent months. The dissents open up a whole new line of questioning for Chair Powell. Four dissents would ordinarily be a sign of discontent with the chair. Since this is likely Powell's last meeting as the chair, it may not be anything more than expressions of concern about the toll of the war. At each meeting this year, the number of open market committee members who have worried they might have to raise rates has increased. We shall see when we get a chance to talk to the chairman.
Mike McKee, stay close. I just want to run through the price action. I've got a big question to come back at you with in just a moment. Equities have stayed slightly lower, no drama here, down by 0.2%. Into this decision, yields were already elevated, particularly at the front end of the curve. They stay somewhat elevated, up 7 basis points at 390. This isn't the kind of decision that moves around crude. Crude is still higher by 6 to 7%, 118 on Brent. Mike McKee, I just wonder, coming into this decision, we were talking about the possibility, the potential that this Federal Reserve introduced some symmetrical reaction function. But looking at that kind of dissent, I wonder if the dissent alone has achieved the same thing, just by introducing some two-way risk, given the level of dissent you can see in this afternoon's decision.
That's a very good point, because, of course, if Powell leaves the Fed, that's one less vote that we know would be on the easing side at this point. We're going to have to wait for the minutes unless the chairman wants to give us a number, which I doubt he will, of people who think that they should be at least suggesting the idea of raising rates in the future. But it's obviously grown since the last time, and feelings have grown more certain, at least among those who think that two-way warning should be included in the statement. It's very, very unusual. Obviously, it has been almost 30 years since we've seen anything like this. And it is definitely a sign that the Fed is split over this question. And one would think that if these people were willing to dissent because they wanted a two-way warning, because they did not want an easing bias in the statement, that they probably would have voted for a rate increase had that been on the table.
Mike McKee, appreciate your time. You're getting the news conference. Looking forward to your line of questioning a little bit later. That news conference, 27 minutes away. We have an 8-4 vote at the Federal Reserve. That's some level of dissent.
Yeah, and didn't Mike just say that that was the first time we've seen that since October 6, 1992? This is unusual. To me, this really highlights the committee aspect of this and the fact that Fed Chair Jay Powell, for all of the jawboning from the president, sits on the more dovish end of this. And I think that that's very notable. So how does he message this, given that A, he probably doesn't matter as much, but B, how does he signal that this isn't necessarily a sign of dysfunction ahead of a new Fed chair coming in, but rather how difficult this moment really is?
The expert on this is Jon Ferro, is the gentleman from the United Kingdom, where dissent is far more evident. There were 2 moments of 4 dissents in the 89-92 period. And the distinction here, John, is those dissents were to ease, to let up as Greenspan was stricter, and this is radically and historically different.
So I remember a level of dissent, a degree of dissent back at the Bank of England coming out of
They
the
basically
financial
told Mervyn
crisis.
King what to do, right?
He wanted more QE.
Yeah.
And I remember the governor being voted down on countless occasions. On this occasion, I'm looking at this level of dissent, and I just wonder if the chairman would welcome it. I think it's probably a good thing right now that there is no groupthink, that we're in a situation at the moment that deserves some kind of debate about where policy should be and where's it going and what kind of risks we face in the economy right now. I actually also think that that's the kind of committee that Kevin Walsh should want to inherit. Groupthink has been a problem at this institution for the last 5 years. I wouldn't look at that as a committee that's voted down the chairman in quite the same way that the committee voted down the governor at the Bank of England a number of years ago. This feels somewhat different. And if you want to move to some kind of symmetrical reaction function at the Federal Reserve, based on that vote, I don't think you need it in the statement. I think the dissent already speaks to it.
Which I think is why I'm noting the increase in the dollar more than anything in bond yields. You're seeing a strengthening in the dollar versus the euro, and that, I think, gives you a sense, maybe at least of the Fed independence question and the fact that this truly is a committee.
But to get out front of the pundits, is this the committee in dissent that President Trump wants?
That's a different question.
Yeah.
This president clearly wants lower interest rates, TK. And the kind of thing that we've just seen voted for right now is not for lower interest rates. You've got a committee that's worried about the prospect of a market thinking they'll always get interest rate cuts, that they don't have to worry about inflation. First and foremost, the first rule for any central banker, any real central banker, anchor inflation expectations. This is part of that exercise.
Yeah, as Neil Dutta put it, he messaged, it's clear that Walsh has his work cut out for him. Good luck convincing some of these folks that it's time to cut rates and potentially overhaul the whole system.
Different question entirely. Bob Michael with us around the table from JP Morgan Asset Management. Bob, your early reflections on this decision?
Yeah, clearly it's in the dissents. Clearly they're moving more towards a symmetrical policy. It's confirmed in the first paragraph where they characterize inflation previously as remained somewhat elevated. They removed the somewhat and it's just elevated. So they're telling us they are increasingly concerned about the level of prices, the level of oil, and the potential pass-through to the system. I think you're right. I think this is less a message about Jay Powell and more a message to the incoming Fed chair that, hey, we could be dissenting. Get prepared for that. I think he may welcome that.
TK asked the question about the president, what the president would like. This is another exercise. It's quite important. Everyone's been worried about the future of the Federal Reserve, central bank independence, will the chairman stay on? That degree of dissent makes the life of, I think, Chairman Powell easier to walk away from this institution. There's no capture of this institution. This institution is still independent. Inflation expectations are still anchored, and that is not dependent on Fed Chair Jay Powell staying on as a governor on this board for the next 2 years.
I see what you did there. So maybe they agreed. 4 people dissent, although one of them is perhaps in a different direction.
I'm not suggesting this was choreographed.
And then opening the door to Jerome Powell coming out and saying, I'm gone. Good luck for you. Go ahead, Kevin
I'm
Walsh.
not suggesting there was any choreography here, just that there are some benefits to that level of dissent. Stephanie Roth of Wolf Research has been going through the statement and reacting to all of this and looking at the price action. Stephanie, your early take, please.
Yeah, I mean, I think, one, it tells us that the committee is certainly divided, and they're not going to be a committee that's willing to just cut rates because Walsh wants them to do so. And it's also interesting because in the hearing last week, Walsh noted that he wants debate in the room, but he wants a more unified statement. And that's certainly not what we got today. So the odds of cuts later this year certainly should go down on the back of what we're seeing today. It's just a committee that certainly doesn't even want to have an easing bias, let alone easing in the near term.
Stephanie, does it surprise you that more members of the Federal Reserve didn't get on board with moving to a more symmetrical type of approach?
A little little bit. I mean, it sounds like it was a fairly divided group, and perhaps there were others that were even more on the fence that didn't officially dissent. This was a big question for the meeting today. There was actually two big questions. One was, were they going to maintain the easing bias in the statement? And many thought that they would actually remove it. So that was, perhaps a bit of a surprise to some extent. And then, of course, the other question is, how is Powell going to answer the questions about what his plans are once Warsh is actually confirmed?
Bob Michael, what is our overall stimulus right now? I know we had timing for tax season where everybody got a check in the mail and all that, but is all of this discussion about an historic post-COVID stimulus that is starting to make the wheels come off the wagon?
Yeah, well, when I was listening to Matt and Subhadra earlier, going into this, I was thinking the Fed would be nuts not to move to a symmetrical posture because we know we have higher prices. And what I heard from them is the economy's doing just fine. They're right. You've got the stimulus from the One Big Beautiful Bill Act. That's not finished. We know there's a tremendous amount of CapEx. When I talk to our clients, they're just getting started on the AI journey. There's a lot more spending to come. And we also know there's a lot of money sloshing around the system. You look at any measure of money, M2,
right,
deposits, money market funds, they're still going vertical.
Can I do an audible?
Yeah, you're about to.
I'm about to do an audible here to get to 4 p.m. and 4:15 p.m. You're the bond pro. What's a so what of $30 billion from one of these Mag 7s? They're going to put the money out. They're going to call Bob Michael. It's all going to go to J.P. Morgan. And when they do that, what does it mean for the dynamics of their balance sheet? What does it mean for the dynamics of the American fixed income market?
Well, the guys reporting today, if they were to issue $30 billion, you'd hardly notice it. That's how big they are. That's how little leverage they've carried. And in our conversations with a lot of big borrowers, we want to know, do they see the demand? These guys have the demand, they'll show you the demand, and they can't monetize it until they put in place the capacity. So there is a big bill to go. And I think these guys are right to borrow and get that bill going.
Can I sell you some twos at 393, up 10 basis points off the back of this?
You asked me, what if the Fed did this? And we never really thought they were going to do this. It's a very artistic way to do it. Nope, I wouldn't touch it
To that
here.
point, to that framing, that's really important. Haven't they achieved the same thing? You don't need it in the statement. Haven't the dissents achieved the same thing?
Well, it's kind of in the statement. It's the last line of the statement. And you talked about, was this choreographed or not? I absolutely think it was. Every single word in the statement is choreographed. They sit there and they debate it. I think this very nicely opens the door for Jay to peacefully depart from the Fed.
So this is their sort of offering to him, their farewell gift to him is here you go, and that ultimately we're going to give Kevin Warsh a hard time?
Okay, I didn't say that. I think what they're indicating is we recognize inflation's a problem. We're not going to sit there and keep advocating for more monetary ease. We're going to be more balanced. Don't worry about the independence of the Fed, Jay. Go off into retirement.
You said you wouldn't buy it. Why wouldn't you buy it?
Because I think the Fed has flipped the tables on the markets right now. And
what does that mean?
I think they've now shifted to something, it's not outright hawkish, but it's more hawkish than where they've been. And then you step back and go, there is still stimulus out there. And we're in the middle of the Middle East conflict. Those things have yet to be settled. Let's just get out of the way of this and see where the market's
Okay, so let's
settle.
build on that. Let's extend the conversation a little bit more. 10s are at 441 right now. What kind of numbers are you thinking about?
Well, we're breaking through to new highs. I don't think you get to 5%, but do you get to something like 4 5/8? Probably. Then I'd get interested. Then you're putting a percent on the Fed funds rate. And I think it's one thing to switch to a symmetrical bias. It's another thing to actually come in and start hiking rates. And I did say I don't expect any changes in rates this year. That's cuts or hikes.
John, 5/8 is how we used to quote paper.
I'm aware,
We'll do 30
yes.
seconds in the next hour.
I'm aware. 10s right now at 441. With this move at the front end of the curve, as I mentioned, up 10 basis points. 394, let's call it 393. Equity's starting to break down just a little bit. Don't want to make too much of this. We're down by 0.3% on the S&P 500. You will notice, Brammer, the underperformance in the Russell down by 1% plus.
These are the companies that are most vulnerable to rates going higher. I really am struck by what Bob's talking about because this is a market shift. And really, it does highlight how much this war has changed the dynamic fundamentally for people who believed that rates would just gradually go lower. And if they don't, how much does that change some of the expectations about the equal weight market, which we've seen being baked in, and frankly, about the broadening out trade? And adding to that, how much steam can there be behind some of the tech trades that are somewhat dependent on some of the consumer aspects? I'm thinking, for example, Meta, advertising, or Amazon, your cleaning supplies, your children's costumes, whatever.
Children's costumes?
I end up buying a lot of those.
Okay, what, ahead of Halloween? Just getting the discount in?
Also senior parties and
okay,
stuff.
All right. Important stuff. Hey, Stephanie, good to hear from you this afternoon. Thanks for your time. Stephanie Roth there of Wolf Research. To talk about the equity market, Kate Moore of Citi joins us now for more. Kate, yields are starting to move higher, getting a squeeze over in crude, Brent out to close to 120. Equities somewhat softer, but not really looking at this as a dramatic event. How would you frame things?
Yeah, I don't think today's event with the Fed is the big event for equities right now. This is also like a massive lollapalooza when it comes to earnings this week, which you know, Jonathan, quite well. And I think the equity market attention is much more there. And so far, everything that we got yesterday, expectations for after the close today and tomorrow are for actually quite strong numbers, reiterating not just the AI tech story, but also actually a very solid U.S. consumer. So I think that is really where kind of equity risk is focused right now, less so on this, what I would argue is also a very interesting set of dissents in the FOMC.
Kate, that said, is there a level or is there some sort of rate of change that gets you concerned as an equity investor about what's going on in the bond market should this Fed suddenly move to put rate hikes squarely on the table?
It seems unlikely, in our view, that the Fed is going to put rate hikes on the table, Lisa. I would say that is not in our kind of any of our distribution for the back half of this year. Stability, even as inflation is warm, and even as the Fed is going to wait and see and more dissent happens across the FOMC. But we, of course, will watch what happens because the relationship between equities and bonds has broken down a number of times over the last couple of years. The correlations are not exactly what they had been historically, and bonds have not been the safe haven asset that some people had become used to in their early days of asset allocation. So across our multi-asset portfolios, we've been more tactical. We've continued to be short duration. I heard Bob a moment ago say he wouldn't be buying 2 years at this point. I tend to agree with that. And we tend to like to take most of our risk on the equity side and think about other diversifiers outside of the fixed income space.
Kate, I look at where we are in the market, and John, I brought this up today because, frankly, I have misplaced this. The Dow up 20% 1 year trailing. SPX up 28% 1 year trailing. All in NASDAQ up 41% 1 year trailing. Kate, it's completely separated from the nation's angst. What do you see as an indication that that keeps going, and how can the Fed assist with that?
Yeah, Tom, one of the things we've been focusing on and something our investment committee was talking about earlier today is the massive dispersion in terms of sectoral earnings, not just this quarter, but through the balance of 2026. And this is also kind of what we're seeing in the overall economy. We've gotten tired, I think, of talking about the K-shaped consumer because even the bottom part of the K seems to be holding up relatively well with decent real wages. But there is a huge amount of dispersion below the surface in the equity market fundamentals and in the macro fundamentals. And that can make people uncomfortable. But unfortunately, what's really driving the market higher has been extremely strong earnings and expected free cash flow from the largest parts of the market cap. And we continue to stay kind of anchored to the equity risk and loving U.S. large caps, even as we recognize it is going to be a very uneven experience and perhaps a better opportunity for some more active management as we go through this year.
Unfortunately, part of the dance right now, monitoring equity markets, bond markets and commodity markets, more importantly, is following these headlines regarding the Middle East. And we've got more from the president. This time, some comments on the Russian leader, Vladimir Putin. They've had a conversation. The Russian leader said he'd like to help with the Iranian enrichment. There has been some suspicion for a while that maybe that enriched uranium would be moved to a third party, and perhaps that would be Russia. And some headlines, I have to say, looking at this, that alludes to that, Lisa, at least this afternoon. Now, as we've said on countless occasions over the last 2 months, one headline that speaks to one story, will last about 5 minutes and things can quickly change. All I can do with you is share with you the current headlines, and they're the headlines that dropped just moments ago.
Yeah, and they include the idea of potentially having a ceasefire with Ukraine and Russia, and then uranium moving from Iran over to Russia. I mean, a lot of things that are a lot of questions. What you do with this, I think people have shrugged it off and moved on because they don't know what to do with it because it's just a headline. So they look at things like, oh, the placating idea of rates going down. You start removing some of these pillars. That's when suddenly some of the angst starts to percolate up a little bit more.
Initially, I think this market took comfort from the intent. The commit to de-escalation, the commitment to de-escalation, and not returning to hostilities. But the fact of the matter is that over this entire period, crude's not been moving, energy's not been flowing sufficiently, and every day over the last 8 sessions, crude keeps grinding higher. What's intriguing about this, every time we get a bit of hopium, some headlines, some reports here, there, and everywhere, crude has really stopped responding to it in the same way.
Yeah.
Brent is still elevated here, TK, at 118 and up on the session by 6%.
I really agree with that. And you see the angst in Southeast Asia and other selected geographies, and it's way more tangible than anything we have. The sum of this is real GDP and the inflation piled on top of it. Kate Moore, if you're still with us, I'm absolutely fascinated how you feel nominal GDP will affect our listeners and viewers. It's still going to be buoyant, I guess, but it's a different nominal GDP, isn't it?
Yeah, it is. And look, I think some of this, Tom, is getting reflected in the consumer confidence data and the surveys that have come out, where consumers are talking about their discomfort. It's not just high gasoline prices. Maybe it's they don't like the direction of the country. They don't feel as confident as they have in the past. Yet the thing that I keep anchoring on is actually what's happening in their behavior. And we've been looking at all this high-frequency consumer data, whether it's around dining outside the home or traveling and spending. And we got some good reports from a couple early consumer companies this quarter. And all of it is showing that despite all these negative surveys, people feeling uncomfortable with the path of the economy, that they're continuing to operate more BAU. So, Tom, this is a little bit of a friction I think we have, which is maybe we don't get a massive acceleration that benefits all parts of the economy, but as long as both the consumer and the AI tech space continue to fire, we feel like you can't be on the sidelines for risk assets.
Hey, Kate, it's good to see you. It's great to catch up, as always. Kate Moore there of Citi, breaking down this equity market and reflecting on this decision from the Federal Reserve about 20 minutes ago. If you're just tuning in, welcome to the programme. In about 10 minutes' time, we'll hear from the Chairman of the Federal Reserve, Chairman Jay Powell, in what should be, his final meeting at the Federal Reserve. Just moments ago, 20 minutes ago, we had a decision from the Federal Reserve to leave interest rates unchanged. What stood out was the degree of dissent, 8-4. 8-4, and that 8-4 vote marking the first time since October 1992 that 4 officials have dissented against an FOMC decision. So something we haven't seen in a number of decades. All of this in anticipation of earnings after the closing bell from some of the biggest companies on the planet, including Microsoft, Amazon, Meta, Alphabet, all of that still to come, which has supported the Nasdaq. The Nasdaq is still positive by 0.25%. But if you want to look at the small caps right now, the Russell down by 1%. Allow me to give you the why. This move at the front end of the yield curve on a 2-year, up 9 basis points to 393 off the back of this move in the commodity market. Lisa, Brent crude 118 and up 6%.
Fed funds futures have now priced out completely any rate cuts this year. We are now pricing out interest rate cuts by the Federal Reserve for 2026. Whether we shift to people starting to price in rate hikes like we did a couple of weeks ago, that remains to be seen. It also is unclear exactly how much the press conference can really do to that. It will be political intrigue and drama with Jerome Powell's future. Nonetheless, this market is moving. It's responding. And the idea that the strength in the U.S. economy can continue is the reason why this is viewed as more inflationary right now than maybe disinflation or outright deflationary later on.
The cross-asset moves are particularly spectacular. We've gone back to where we were about a month ago. About a month ago, when the equity market was about 13 percentage points south of where it is right now in the S&P 500. Yields are back through the highs. On some maturities, I'm looking more at the long end of the curve, the long bond on 30s. And crude has made new highs as well. And what's more important, I think, away from the front month of the futures curve, is what's happening on longer dated prices as well. You've talked about this throughout the week on Bloomberg Surveillance, Bramo, where December's trading, where the latter months are, the back end of the futures curve, that's making new highs as well. This is a market that's pricing high for longer, not just for interest rates, but for energy as well.
Yeah, and that's why we always have been talking about boiling the frog, because it's getting hotter and hotter and hotter. And at what point do capital markets start to slow down as a result of benchmark rates going higher and inflationary pressures being there?
This has been the exercise for us now for the best part of 2 months. Energy shock, rate shock. What does it mean for growth? But that's the question. I think is still an open-ended question, really. We've seen it in commodities. We've seen it in energy. And I'm asking this question with America in mind before we get to the international backdrop where it's much harder. What does it mean for US growth, if anything at all?
Well, I think we have to acknowledge that the three dissents weren't in favor of hikes. They were in favor of a more symmetrical policy, which leaves 3/4 of the Fed still biased towards ease. So let's accept that. That said, the bar to hikes just got lowered a notch. What does it mean for growth? It means that unless the economy can absorb higher prices from energy and higher cost of funding from where rates are, then you're going to see a real slowdown.
At what point do higher yields start to crimp the capital markets activity? I'm talking about all the bond sales. I'm talking about beyond that, mergers and acquisitions that have been absolutely flying recently.
I don't think we're there yet. I think really you'd have to get the 10-year above 5% to create any kind of damage. And let's also remember that most of corporate America finances itself with floating rate. We should know that from private credit and direct lending now. So unless the Fed is going to start hiking rates, which we're not calling for this year, then the cost of funding for most of corporate America is going to remain roughly the same.
Is the Fed doing policy for the haves? It's just as simple as that. The dichotomy here between the haves and the have-nots, we witness the tension of 4 cents. How does the new chairman address the have-nots, the people flat on their back?
I don't think it's a question of have or have-nots, and I think you go back to the 2022 experience. I think they're scarred from that. They were late to react, inflation was painful, and it hit all levels of the economy, both the haves and the have-nots. And I think they are genuinely, as a body, trying to get their arms around that. And there are a group of people who are courageous enough to step forward and do something different than what's been done in the past.
What will the next meeting look like for you? If you guess right now what the next meeting will look like.
I think there will be a lot more two-way debate on whether they should be hiking rates.
Right.
Will they have to cut rates down the road, or will they remain
Larry
neutral?
Meyer wrote that monograph years ago about Alan Greenspan, and there was some real back and forth going on way back. Is that what we're up for now? Is a Lawrence Meyer, Alan Greenspan Fed with Chairman Warsh?
It probably, it doesn't feel like the Middle East is in the rearview mirror or will be 6 weeks from now.
I've got a personnel question. When they next meet, should be Chairman Warsh. Is Powell there or not?
I don't think he will be.
You think he steps away?
I think the Fed is in good hands with Warsh. I think you've had a group of people say, don't worry, we're still independent. And I think you've just got to pass the reins on and let somebody else try things that may be a little bit more innovative, a little bit different from what you've done.
Is there a market liability if he doesn't do that? Is there a market reaction?
I don't think so. I think there will be a lot of concern that it's too much of a political decision. I think the door is wide open to exit gracefully.
John, June 17th, I guess I got to cancel my plans. I was supposed to be in Cheltenham, but instead June 17th, I'll be here.
Two things. One, Cheltenham, and two, for the record, I won't be here. I will be away. I won't be at Cheltenham, though. So
You won't be in Cheltenham?
I'll be missing that one. Does this make the life of Kevin Warsh just that little bit easier? Entering the Federal Reserve, this might sound somewhat counterintuitive, but entering the Federal Reserve under a little bit of a dark cloud, where some people are concerned, particularly the Fed watchers, about the future of this institution and central bank independence. I think not only have these dissenters done Chairman Powell a favour, I do think they've done Kevin Warsh a favour as well. Yes, he doesn't want this playing out in public, but one of the criticisms of this institution, particularly under Chairman Powell, is the groupthink. I think it's refreshing to see the dissent. We've been asking for it for ages. You can't complain about it once you've got it.
Not only that, but arguably the inner Kevin Warsh is a hawk, is somebody who wants to say inflation is a choice. He didn't mention employment once. We didn't talk about the labor market in those hearings. He wasn't talking about the average American flat on their back. He talked about inflation and how important it was to the credibility of the Fed to get it under control. So what's the risk that he comes in and is actually incredibly hawkish and joins those three other dissenters in case of a more symmetric risk? What does the market do with that?
This is the secret sauce of central bank independence. If you want to make it easier to cut rates, convince the market you're willing to hike. And we have gone some way through that exercise this afternoon with this degree of dissent.
What's interesting is what Bob said, is that levels here are not going to necessarily hijack any of the capital markets activity. It's not going to slow the M&A. It's not going to slow the huge tech trade that's really been the ballast to this market. So what exactly is it going to do to actually slow the economy and actually achieve what the Fed is looking to do?
Bob Michael, in just about 90 seconds' time, the chairman of the Federal Reserve, Jay Powell, walks into that room and steps up behind that podium for probably, likely, the final time. Just a reflection on this man and his tenure at this institution.
I think he was dealt some shockingly difficult circumstances, and I think he did his best to navigate through them. We did get through COVID. We got through the regional banking crisis. We've gotten through different rounds of tariffs, and we're looking at an economy that's actually doing pretty well considering. I think he's done a really good job, and Warsh isn't an outsider. He's an insider. He was at the Fed before. He'll do a good job.
Bob Michael, appreciate your time, sir. Thank you. Bob Michael there of JP Morgan Asset Management. In just a moment, the chairman of the Federal Reserve, Jay Powell, stepping through that door, stepping behind that podium for most likely the final time, following this decision at the Federal Reserve to keep interest rates unchanged, with an 8-4 vote on the FOMC, something we haven't seen since the 1990s, as we get some dissent pushing for a Federal Reserve to articulate a more symmetrical reaction function. Ultimately, that view was voted down. How this Federal Reserve is set up for Kevin Warsh, what kind of FOMC he's inheriting, is going to be an important part of the discussion that we have over the next 60 minutes in this news conference. And also, the future of this chairman, not as the chairman, but as a governor of the board. He has the option to stay there until 2028. Will he take that option? Will we find out in this news conference? The last time we heard from the chairman of the Federal Reserve, he wanted that DOJ investigation into this institution wrapped up with transparency 1 and finality 2. Have we met his bar based on what we've heard in the last week?
And has anything that the Fed did in terms of the committee and the dissents there given him a green light to take this exit stage and go off to golf and give speeches, et cetera? Ultimately, what he says here will be more for the political aspect than it will necessarily for the path ahead for the Federal Reserve, because ultimately that job has been done. The committee is no longer a committee of 1. It is a committee of 12, and they are asserting the power of disagreement. That, I think, does make it somewhat easier for him to come out and have his swan song.
This is how the stage is set going into this news conference. The scores look like this. Equities on the S&P 500, negative by just 1/3% on the S&P. On the Russell, the small caps down by about 1%. The move in the small caps driven by this move in the bond market on 2s, 10s and 30s, elevated at the front end of the curve. A move on the 2-year of some 10 basis points. Call it 8 or 9 right now at 392. That's the move in fixed income off the back of this big move in crude. 8 consecutive days of gains for Brent crude, the longest daily winning streak we've seen for Brent going back to 2022 and May of that year. For the final time, your chairman of the Federal Reserve, Jay Powell, steps up to the podium. Let's take a listen.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The U.S. economy has been expanding at a solid pace. While job gains have remained low, the unemployment rate has been little changed in recent months. Inflation has moved up and is elevated, in part reflecting the recent increase in global energy prices. Today, the FOMC decided to leave our policy rate unchanged. We see the current stance of monetary policy as appropriate to promote progress toward our maximum employment and 2% inflation goals. Developments in the Middle East are contributing to a high level of uncertainty about the economic outlook, and we will remain attentive to risks to both sides of our dual mandate. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has been expanding at a solid pace. Consumer spending has been resilient, and business fixed investment has continued to expand at a brisk pace. In contrast, activity in the housing sector has remained weak. In the labor market, the unemployment rate was 4.3% in March and has changed little in recent months. Job gains have remained low. A good part of the slowing in the pace of the job growth over the past year reflects a decline in the growth of the labor force due to lower immigration and labor force participation. though labor demand has clearly softened as well. Other indicators, including job openings, layoffs, hiring, and nominal wage growth, generally show little change in recent months. Inflation has moved up recently and is elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 3.5% over the 12 months ending in March, boosted by the significant rise in global oil prices that has resulted from the conflict in the Middle East. Excluding the volatile food and energy categories, core PCE prices rose 3.2% over the 12 months ending in March. This relatively high rate largely reflects the effects of tariffs on prices in the goods sector. Near-term measures of inflation expectations have risen this year, likely because of the substantial rise in oil prices. Most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 3.5% to 3.75%. The economic outlook remains highly uncertain, and the conflict in the Middle East has added to this uncertainty. In the near term, higher energy prices will push up overall inflation. Beyond that, the scope and duration of potential effects on the economy remain unclear, as does the future course of the conflict itself. We will continue to monitor the risks to both sides of our dual mandate. We are well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. Monetary policy is not on a preset course, and we will make our decisions on a meeting-by-meeting basis. This is my last press conference as chair, and I will close with a few thoughts. First, I want to congratulate Kevin Warsh on his advancement out of the Senate Banking Committee this morning. This is an important step forward, and I wish him well as that process continues. The Federal Reserve exists for one fundamental purpose: to foster the economic conditions in which American families and businesses can thrive. Stable prices, a strong job market, and a financial system they can depend on. Every decision we make, whether about interest rates or regulatory and supervisory matters or other issues, is made in service of that purpose. Our decisions reflect the collective judgment of the Board of Governors and the Federal Open Market Committee, colleagues who demonstrate analytical rigor, principled judgment, and a genuine commitment to the public interest. Our collaborative and deliberative process has long reflected a shared commitment to finding common ground in service to our mission. This institution is resilient, capable, and staffed by professionals of extraordinary talent and exceptional dedication. It has been a privilege to serve alongside so many great public servants at the Board of Governors and around the Federal Reserve System. The Fed's work is only as effective as the public's understanding of it, and you, the press, are essential to keeping the public informed about what we do and why. The people we serve benefit from your careful reporting. I welcomed the announcement last Friday by the U.S. Attorney for the District of Columbia that she had closed the criminal investigation. She also noted, however, that she would not hesitate to restart the investigation. Over the weekend, the Department of Justice provided assurances that they will not reopen the investigation unless there's a criminal referral from the Fed's Inspector General. And, absent such a referral, if they do appeal the recent court decision, they would not seek, as part of that appeal, to restart the investigation or send new subpoenas. I've said that I will not leave the board until this investigation is well and truly over, with transparency and finality, and I stand by that. I'm encouraged by recent developments, and I'm watching the remaining steps in this process carefully. My decisions on these matters will continue to be guided entirely by what I believe is in the best interest of the institution and the people we serve. After my term as chair ends on May 15, I will continue to serve as a governor for a period of time to be determined. I plan to keep a low profile as a governor. There's only ever one chair of the Federal Reserve Board. When Kevin Warsh is confirmed and sworn in, he will be that chair. Once sworn in as board chair, his new colleagues will elect him to chair the FOMC as well. As I regularly point out from this podium, our success in delivering our goals matters for all Americans. I'm confident that the Fed will continue to do its work with objectivity, integrity, and a deep commitment to serve the American people. Thank you, and I look forward to your questions.
Thank you, Mr. Chair. Appreciate the kind words about the press. Often doesn't come from the podium in different places, but appreciate that. Can you talk about what is gone into your decision to remain on the board? What kind of criteria are you weighing, and how long might you stay? Thank you.
Sure. So, my concern is really about the series of legal attacks on the Fed, which threaten our ability to conduct monetary policy without considering political factors. And I want to note here, this has nothing whatever to do with verbal criticism by elected officials. I've never suggested that such verbal criticism is a problem, and neither has anyone else here. But these legal actions by the administration are unprecedented in our 113-year history, and there are ongoing threats of additional such actions. I worry that these attacks are battering the institution and putting at risk the thing that really matters to the public, which is the ability to conduct monetary policy without taking into consideration political factors. It is so important for our economy, for the people that we serve, that they can depend over time on a central bank that operates that way, free of political influence. It's part of the absolute foundation of this amazing economy that we have. It's just one of the many reasons why the U.S. economy is the envy of the world. That piece of institutional architecture separates successful countries from unsuccessful countries. It is extremely important, not for the people who work at the Fed at any given time, but for the people that we serve, that the Fed remain able to conduct monetary policy in a way that doesn't get pulled into politics, trying to help or hurt any particular politician or political party. It's critical for the people that we serve. In terms of when I would leave, I will leave when I think it's appropriate to do so. Was that all your questions, or was there?
Well, I just have a follow-up, which is, what would you say to the criticism that by remaining on the board, you're actually taking a political act and denying President Trump the majority of the board, which as president he would have if you left?
I don't see that at all. As I mentioned, I'm literally staying because of the actions that have been taken. I had long planned to be retiring, and the things that have happened in the last 3 months have, I think, left me no choice but to stay until I see them through at least that long. In addition, I don't see how this will interfere. My intention is not to interfere. I was a governor for almost 6 years, and the tradition is at the Fed that governors who understand how difficult the role of chair is, and as a soon-to-be former chair, I do understand how hard it is to get consensus with 19 strong-minded people. You work with the chair. You try to be heard, but also collaborate with the chair and try to support the chair when you can. When you can't, you can't. And I think that's the attitude that people generally take, and that's the attitude that I'll take.
Nick.
Chair Powell, if I could ask about the inflation outlook. In March, you described the standard practice of looking through energy shocks as conditional on inflation expectations staying anchored. Since that meeting, there has been very little progress reopening key energy trade corridors. Can you help us understand how the inflation outlook has changed in the intermeeting period, beginning with the prospects for tariff pass-through resolving on the timeline that you had outlined in March, before getting to the energy shock that is now on top?
So, I would look at it this way. For a long time, we've been working on the hypothesis, really, that tariffs would lead to a one-time price increase and that would go away over time. In other words, that there would be no further change, so measured inflation wouldn't reflect that higher level going up more and more. And it's time for that to happen. We really do expect that to be happening in the next 2 quarters. So we'll be watching very carefully to see that what we've thought all along would happen. That's the kind of critical part of the forecast. We need to really see that. With energy, it's so hard to say. I mentioned, in sort of the textbook, you would look through an oil shock because they tend to be short-lived and they tend to revert, and monetary policy works with long and variable lags. So you wouldn't necessarily react right away. I think that is all the more true given that we're several years above 2% inflation and that we're already looking through the tariff shock. So I think we're going to be very cautious about that. But the question about looking through energy really is not in front of us right now. It hasn't even peaked yet. And I think we'd want to see the backside of that and progress on tariffs before we even thought about reducing rates.
So if I could follow up, the statement today preserves language that has taken on some meaning as it was socialized when the committee was actively lowering rates. Why is that easing bias still ripe, given how different the inflation outlook is now versus a meeting or two ago? And what more would have to happen for it to get evicted?
So that was, as you will recall, we had a discussion about that at the last meeting, and we talked about it in the press conference after the March meeting. We had the same today. We had quite a vigorous discussion about that very issue and the guidance, and is it still appropriate, and that kind of thing. And I would say that the number of people on the committee who either could support that language changing to a more neutral stance so that a hike is as likely as a cut, that number has increased over the intermeeting period, and it's easy to see why. I mean, it's a good question, right? You see, inflation has moved up over the interim a bit. Core inflation's 3.2 now, moving, albeit just a little bit, in the wrong direction. And we know that there will be, that there's headline inflation coming out of the Gulf, and we don't know how much that will be. We're going to need to see. So it makes all the sense in the world that people would look at that and we'd have a vigorous discussion about that. You saw that 3 people dissented over the language. I think all of those people agreed with the rate decision. So the majority of the committee did not want to do that, and I didn't think we needed to do it at this meeting. It really was just a question of why do we need to do that now? We have so much to learn. There's so much uncertainty about the path ahead. There doesn't need to be any rush to make that decision now, because what happens in the next 30, 60 days, even by the next meeting, could really change the picture around that language. So, it's a much closer thing on the committee than it was in March, and that makes all the sense in the world, it seems to me.
So Claire Jones, Financial Times. Just going back to this issue of the easing bias, we've now got oil approaching $120 a barrel when it comes to the benchmark Brent crude. If it stays around those levels 6 weeks from now, what would be your best guess as to whether the easing bias will still be in the statement? Thank you.
I wouldn't want to guess. Well, first of all, we're going to have new leadership in all likelihood by then, and new leadership's going to have a very important role to play in that. So I won't be standing here at this podium to answer your question. So I don't know. As I mentioned, that's all I can really say is that we had a great discussion about that today. It's gotten to be a better question in the interim period. We had the discussion. A majority are still on the page of not feeling the need to move to that level, and that's where I am. I get it, though. At a certain point, you would move, and that conceivably could come as soon as the next meeting.
Thank you. Just to follow on, the new leadership also seemed rather lukewarm on press conferences and on the dot plots. What would your advice to him be on these communication tools? So
I'm not going to give him any advice through you today here, but I think communications generally is. I think every incoming chair takes a look at communications, and it's a very healthy thing. I mean, communications it's very complex, and you can always be looking at new things. And if that happens, it feels like it's going to happen. That's a completely appropriate thing.
Neil. Hi, Chair Powell. Neil Irwin with Axios. Can you tell us if you've been in touch with incoming Chairman Warsh? To what extent is this a normal transition process versus all the things swirling around, something unusual, and what can we expect when he takes that podium in a few weeks?
I haven't seen him since seeing him at a dinner in January where I congratulated him and had a nice chat with him. Haven't seen him. I don't know what a normal process is. The last process was with Janet Yellen, with whom I had worked for 6 years, and so it was. We were sitting down the hall from each other, so it was a very different thing. I think this is and will be a very normal, standard kind of a transition process. So that's what I expect. I have every reason to think it will be.
Quick follow-up: is the Supreme Court ruling on Governor Cook a factor in when you may leave as a governor?
I wasn't thinking of it as such, but no, not really. I mean, I'm thinking more of the other things I mentioned.
Hi, thanks for taking our question. I wanted to ask a question about your tenure, and Chris Rugaber at Associated Press. During your tenure as chair, you often spoke about how disadvantaged Americans benefited from extended periods of low unemployment. In the new framework the Fed adopted in 2020, some economists say elevated the Fed's employment mandate. Are you worried that the pandemic inflation spike that followed will make future Fed chairs more reluctant to pursue a hot jobs market? And should they be?
I don't know the answer to that. I mean, what we experienced in the teens, the mid-teens, was really low levels of unemployment for a long period of time and no reaction from inflation. And we all very much took notice of that. We also noticed that the biggest wage gains were going to people at the bottom end of the income spectrum. And we had many, many reports of, I mean, it felt like a fairly stable equilibrium, and a lot of benefits were flowing to people at the bottom end of the income spectrum, including companies were, setting up in people who were confined and like training them before they got out. And it was a very healthy sort of set of societal dynamics. So, of course, I think anybody would love to get back to that. I don't think that anything that happened to create the global pandemic inflation was in any way related to overweighting the employment market. I mean, it was a global shock that happened essentially very, very similarly all over the world that had to do with closing, reopening, stimulus, and all that. And I mean, you could look at a graph of 10 big economies on the page and not know which was the U.S. and which was Germany, France, and things like that. So I don't think that insight was in any way responsible for the high inflation that we experienced. So, I mean, I think it's always been a balance. You've got to be strong on both of our dual mandates, and for example, now we don't feel that the labor market is at all a source of inflation, so we don't need to be worrying about that. It's been a long time since we have had to worry about that. Well, actually, during the pandemic recovery, the labor market was super overheated and tight, and that's when we had to worry about it, but not now.
And just on the other issue, do you need more assurance from the Justice Department before stepping down? Is that what you're waiting for, or what else?
I'm waiting, for the investigation to be well and truly over with finality and transparency, and I'm waiting for that, and I will leave when I think it's appropriate to do so.
Michael McKee from Bloomberg Television and Radio. I'd like to ask you if you could explain a little more or characterize a little more the discussion about the two-sided view and interest rates, because there were some members of the Open Market Committee who've been suggesting that we may need to raise interest rates even absent the war because inflation was not coming down fast enough. Is there any sense that interest rates might have to go up, or was this just a setup to sort of warn people that you're worried about the war impacts?
So nobody, the three dissenters and others who could have supported that, and others who were voters and non-voters who preferred it, they all supported the rate decision, right? So people are not saying we need to hike now. It's more a question of, don't we kind of feel that we should be neutral? And what are markets doing? People argue that this is consistent with markets are doing. And again, it's a very fair question, but these changes, it's a form of forward guidance, and you don't want to make them in a way that will be sustained and continue to make sense, and not something you need to take back, fairly quickly. So I think we just, a group of us, including me, didn't feel like we needed to be in a hurry on that markets are not confused about our reaction function. We don't have a problem to solve on that. But the other side of the argument is a good argument, too, as I mentioned. It's a perfectly good argument to be having, good discussion to be having. So, and it came out the way it came out.
Well, you've got 3 dissents in favor of two-sided warning. You've got yourself staying on the board. You've got the criticism that does come from elected officials, and you've got a lot of critics who have faulted the Fed for being too slow 2021 with inflation. Are you worried about Fed credibility under all of this? Is that one reason that you want to stay on?
Not driving my thinking now. I mean, monetary policy is going to get made by, 19 people. There's a lot of stability there. I mean, if you think about it, every new Fed chair has the same situation, which is you've got 18 colleagues on the FOMC, 11 of them vote during any year, and your job is to create consensus. It's to talk to them, understand them, be inside their thinking, and be able to pull them together and get consensus and move. And that's what every Fed chair has to do. And I think Kevin Warsh is actually quite well. He has the capabilities, skills to be very good at that, I would think. So I think I'm not so worried about that process. I think that'll work itself out.
Thank you, Chair Powell. Howard Schneider with Reuters. You mentioned that staying on as a governor, you intend to keep a low profile. I'm just wondering if you could give us a little more detail on what that looks like and how you can. Touche. Walk down the steps. What that looks like, and particularly around the policy discussion, how you're able to have your intervention and not be a shadow chair and not have a kind of an outsized influence over the process.
Yeah, that's just something I would never do. The shadow chair thing. No, I don't know what the exact specifics of it will be, but I'm going back to being a governor. I respect the role of chair. I was a chair. I was a governor for 6 years, and I know what that's like. I know, and I had a pretty front row seat particularly with Chair Yellen, to whom I was close when I worked with Chairman Bernanke for 2 years, but. I was brand new at that time. So I got a sense of what it was, and I had real sympathy for how hard it is to get that group to consensus. And I always felt like I don't want to add to that unnecessarily. And that means try to support the chairs where the direction the chair wants to go in, if you can. If you can't, you can't. And I think that's the way it's always worked there, because the chair only has one vote, plus the ability to develop consensus. And if people won't be they won't, if they're not flexible at all, then how do you ever do that? And so that's why the authority the chair has really is to develop relationships with people and work with them, and then put something forward that has consensus. And I propose to be a very constructive participant in that process, really out of respect for the office of the chair.
And in your view as a soon-to-be governor, how do you see the risks of oil prices bleeding into core inflation in coming weeks? Because it seems like the commentary that was coming from particularly some of the Reserve Bank presidents, they were elevated concerns about the bleed into core. And, here we are with 3 dissents now. What do you see as the prospect of a core inflation?
Those prospects are real. Remember, though, and they're real, and the real thing is we're going to have to wait and see. We're going to need to see. And the good news is we think our policy stance is in a very good place for us to wait and see. We're right kind of at the high end of neutral or perhaps mildly restrictive. The labor market shows more and more signs of stability, whereas inflation is kind of misbehaving. And so maybe a little bit of restriction or the high end of neutral is just the right place to be. So we can wait here and see how things work out before we act. And we'll see how much how much does come through into core. You see it already in airfares, of course, but you may see it in many other places. We just don't know yet, and it's so unknowable, because how long will the strait be closed? You can develop any number of scenarios that you want, but we really won't know till we know. So fortunately, we're in a good place to wait and let things develop.
Thanks, Mr. Chairman. You started holding post-meeting press conferences for every meeting as opposed to the ones with with SEPs. Can you talk about why you see that as a net positive?
So we always said, when we were doing quarterly press conferences, we always said we can move at any meeting, but we only ever moved at the quarterly SEP meetings where we had the press conference. So if you think about it, during the pandemic, we were moving like a lot at every meeting and sometimes between meetings, and doing that without a press conference, I think, would have been quite challenging. It's become the industry norm. It's the standard. I don't know whether that has to remain that way. I don't know. I mean, it's just something people have become used to, and I do think it's quite helpful to, I try to deliver a message on behalf of the committee rather than 18 other people going out and delivering their message, and it's going to be all over the place because we do, thankfully, have widely disparate views.
Okay, thanks. The other thing I wanted to ask about was the communications review from last year. Could you describe the debate last year, what changes were considered, what you wanted, and what prevented action, any action on those changes? So
I'm not going to go into the real small specifics, but what we found very quickly was that making changes, making really large changes, for example, to the dot plot or the SEP, it didn't have, we couldn't come up with anything that had really broad support on the committee, and so we just moved on. We didn't really do as much on that as we might have. And I was never the world's biggest fan of the dot plot, but you can't beat something with nothing. And we've looked at a bunch of things, and it's something, like I said, I think every new chair is going to look at our suite of communications and think about what would be changes. We are the only major central bank that doesn't publish a forecast, and that's because we have a 19-person committee, and you try to do that at the board. That's hard. At the committee, that's hard. It's hard if you do it at the staff. So it works. I think our communications are fine, but looking at doing it in a different and better way is the most natural thing in the world.
Thank you. Colby Smith with the New York Times. If I could follow up on Mike's question about hikes, are we right to assume that the hawkish outcome for the Fed is still one in which the committee just extends the pause in rate cuts? And to what extent is there a growing sense within the committee that monetary policy really isn't just restrictive at all right now? The economy is holding up relatively well despite this major energy shock. The unemployment rate has ticked lower. Inflation was moving sideways even before the war and is now moving higher. So where is the committee at on that debate?
Where we're at is we think our policy rate is in a good place. If we need to hike, we will certainly signal that, and we will certainly do it. And if we need to cut, then, or if it's appropriate to cut, then we'll signal the opposite. I think because we feel like we're in a good place to move in either direction. Nobody's calling for a hike right now, so it really is going to depend on how things evolve, and that's really where it is. As I mentioned, much closer question this cycle on changing the guidance, but ultimately we didn't.
And as it relates to the war, at what point do you think the risk to growth will be larger than the risk to inflation as this conflict drags on?
You just have to find that out empirically. Given our the fact that we're a big exporter of energy, and that our economy is far less energy intensive, oil intensive than it was during the 70s. The effects on the United States are really substantially less than those of Western Europe or Asia, who are feeling much greater effects from these things. The effects we're feeling in the current situation currently, and in sort of what's priced in, which is a relatively quick outcome. If this goes on for much longer and prices go much higher, then we'll feel that much more. And of course, I'm talking about aggregate inflation numbers. We're very well aware that people are experiencing higher gas prices all over the country now, and that hurts. And those hikes may continue to happen. And other things are going to start to reflect airline fares I've mentioned, and other products and services that are dependent upon petroleum and derivatives of petroleum. People are going to start to feel that.
Edward.
Thank you, Chair Powell. Edward Lawrence with Fox Business. So I guess I'll just ask you directly on this. The markets don't see a rate cut at all this year, is what they're predicting. Do you think that we are at the neutral rate? Why or why not?
You know, the neutral rate is we cannot know it with certainty. I think pretty close to the neutral rate. Yeah, I always had it, you know, between 3% and 4%. We're a little north of 3.5%, so that's well in the range of what I would consider a reasonable, but at the higher end of the range of what I would consider reasonable neutral rate. You know, I think the labor market is still probably cooling off just a little bit, and I don't think there's much of a case for any case really for policy looking, you know, meaningfully restrictive, maybe mildly restrictive or neutral, I would say.
And I want to follow up on some of the other questions about your future a little bit. The first time we've seen 4 dissents now since October of 1992. Are you handing off a divided Fed?
You know, the thing to remember is we have always had vigorous debates, and they're excellent debates. I have to say they've been really good, and we're in an unusually difficult situation. So we've really had 4 supply shocks. You can say more than 4, but at a minimum, we had the pandemic, we had the invasion of Ukraine, we had tariffs, and now we have Iran and the oil, you know, the oil spike. So every supply shock has the capability of driving inflation up and unemployment up. And what do? You know, it's central bank has a really hard time knowing what to do. So the right thing to do is to try to balance the achievement of those 2 goals, and that's what our framework calls for us to do. But these are really tough, difficult judgments. You've got to have a forecast for each variable. You've got to think how long it's going to take to get back to target. You got to think how restrictive or not is policy. So it's only natural that you have a range of views on the committee. You know, people are going to see it different ways. They're going to have different risk tolerances and that kind of thing. I mean, if everybody agreed, that would be surprising. And I think it's partly a function of the extraordinarily challenging set of supply shocks that we've been dealing with now for 5-6 years.
Thank you so much, Chair Powell. Selena Wayne with ABC News. Are you confident that Kevin Warsh will stand up to political pressure from President Trump?
So he testified very strongly to that effect in his hearing, and I'll take him at his word.
And when it comes to gas, right now it's over $4 a gallon. Inflation just hit a 2-year high. Should Americans expect to be paying higher gas prices for the rest of this year? And in your view, does that take a rate cut off of the table? And secondly, by staying on as Fed governor, what message do you think you're sending to the president?
I don't know what gas prices are going to do for the rest of the year. And it will depend on how long the strait remains closed and how quickly it can be reopened and that kind of thing. But remember, when gas prices go up, that's disposable income coming out of people's pockets. So they're going to spend less on other things. So there will be a hit to GDP. So it's a question whether spending goes down to offset the inflationary effects. So it's not the answer isn't obvious ex ante whether you should move your rate over because of that. We'll have to see how it evolves.
And the message it sends to President Trump by staying on?
I'll stand on what I said earlier.
Victoria.
Hi, Victoria Guido with Politico. During your tenure, Fed independence has come under pressure in a lot of different ways. And I was just wondering, practically speaking, where do you see Fed independence as coming from? Is it the law? Is it political support from Congress? Is it the actions of the Fed? What sustains Fed independence?
Well, it's to a significant extent, it is the law. And, we've had to go to court to successfully so far to defend it. But the law does create a setting in which the Fed can and is directed to make monetary policy without consideration of political factors. And so part of it is the law. But it goes beyond that, though. There's a set of customs. There's a boundary line between the Fed and the administration, between the Fed and the Treasury Department. And we need to continue to respect those boundaries about what the Fed is responsible for and what the Treasury is responsible for and what the rest of the administration is responsible for. So some of it is legal, In fact, it's all legal at the end of the day, but it's more than just monetary policy. We don't want to use our tools we haven't wanted to use our tools to achieve goals that are really clearly outside our mandate. Every administration looks at our tools and thinks that would be good to repurpose those to serve other purposes, but that's dragging us into politics and into fiscal policy. So we've resisted that.
Well, and maybe another way of asking it too is, do you think that Fed independence is as strong now as when you became chair? And if so, why?
Look, I think it's at risk. I mean, I think these legal assaults, if you will, as I mentioned, the institution is being battered over these things. We're having to resort to, the courts to enforce our legal, it's not so much independence. It's really the ability to make monetary policy without political considerations. That's what we're talking about. And we've had to do that, and we've been successful so far, but that's not over. None of that is concluded yet. And it's really important. It's not about people who work at the Fed or the institution. It's about the benefits of a central bank that makes decisions based on analysis and our best thinking, rather than trying to help or hurt politicians. It's that there's a bright line between central banks who do one and do the other, and successful countries have uniformly, successful advanced economy countries have a really strong set of protections around their central bank just for that reason. So that's what it's all about. I think I am confident, as I said in my remarks, that the Fed will continue to make its decision based on analysis, rigorous analysis, and not on political considerations. But we've had to fight for it, and I'd like to think that we can get out of that era and go back to respecting, what the law says and what custom has been, which is to, let the Fed do our thing. It's an institution full of human beings who work super hard to get things right for the benefit of the public. We're all human. Don't expect for perfection, but do expect us to make, decisions without political considerations and the very best analysis we can bring.
Katerina Saraiva, Bloomberg News. How would you characterize what you've heard from your colleagues on your decision to stay? Do you have their support? And then have you heard concern from your colleagues about continued legal attacks from the executive branch? Is this something that others have, talked to you about?
So I think that I don't want to report on what my colleagues think. They can speak for themselves. But there are widespread concerns that these things may continue. That's all I'll say. And and that would be a problem. And so.
And then I just also wanted to ask about Governor Waller's speech on the reserve banks. Do you have any thoughts on centralizing some of those functions in the way he described? And then are you concerned that something like that could potentially be a slippery slope to consolidate reserve bank functions even more in such a way where the central bank ultimately loses some of that important regional information?
So we try to be good stewards of the public's money and efficient. And Chris Waller is particularly passionate about that. Of course, so are the presidents. And, it's a question of how do you accomplish it? We of course, and Chris said this in his speech, we want 12 strong, independent central banks with their own staffs and their own monetary policy views and all that. But, there are things that are done in all 12 which could well be done at one much more efficiently and with cost savings. And so there's a back and forth going on that. But everybody's on the same page. The other thing he touched on was the idea of removing reserve bank presidents from office over different views on monetary policy, and I would just agree with him so strongly that would be the beginning of the end of the Fed's ability to make monetary policy independently. If every administration could come in and do that, you're just another cabinet agency at that point. So that's not something that I would support. Chris said the same thing.
Thanks, Chair Powell. Christine Romans, NBC News. I want to ask about legacy. When the history books are written, how do you think your stewardship at the Fed will be remembered for the past 8 years?
You know, I'm going to just say that that's for someone else to say. I'll give you a mulligan on that.
All right, I'm going to ask you about misbehaving inflation then. You talked about those 4 big shocks, supply shocks over the past 5 years, and inflation still misbehaving. What's your message to American families who feel like inflation has not been under control for them really since the COVID reopening?
You know, we're committed to bring inflation back down to 2% and sustainably. That's our goal, and we'll stick at it until that happens. We keep getting, these events keep happening, which keep driving up costs. And, you know, the best thing we can do is to use our tools to guide inflation back down to 2%. I think trying to get there really quickly could be very costly in terms of job loss and things like that. But we try to get there over time in a way that does the least damage possible. And, you know, our commitment to that is never ending and unshakable.
How would you describe the economy outside of the misbehaving inflation? I mean, it's still awfully resilient given all of the blows.
I don't know that you can be awfully resilient. So it's actually quite resilient, I would say, because it's a positive thing. If I can have that amendment, yeah, you know, growth is really solid across our economy. Some of that is that consumer spending is hanging in pretty well. The most recent data are good. And some of it is just the apparently insatiable demand for data centers all over the United States. So a lot of business investment going into building data centers, and every reason to think that that continues. So you've got an economy that's growing at 2% or better. PDFP, which is private domestic final purchases, which is really a better signal of a momentum in the economy, is actually higher than that. So that's a positive thing. If you look at the unemployment rate, it's 4.3%. So that's a low rate. That's pretty close to mainstream estimates of the natural rate. We've been there for a long time. So it doesn't feel like a good labor market to some who don't have jobs, because quits are really low, hires are really low, and there's effectively no new net job creation. So that's you know, in a sense, the labor market is in balance. But it's an unusual and uncomfortable kind of a balance where people who don't have jobs will have a hard time breaking in unless somebody quits their job. So that's pretty good. You know, inflation is the thing we need to work on, and it's partly tariffs, which we think that inflation should subside over the course of this year, because it's kind of a one-time increase. It shouldn't be repeated, and that should start happening pretty soon. The energy inflation that we're getting should go through fairly quickly. And we'll just have to see how that works out. In the meantime, you know, we think our policy stance is in a good place for us to hold and wait developments.
Jennifer. Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. At the risk of beating the dead horse here, clearly 3 members objected to keeping that easing bias in the statement. And you said that the majority still didn't need to move to new language at this point. So does the majority of the committee still have a bias towards cuts at this point, or has the bias on the committee shifted away from cuts towards holding or hikes if that was needed?
So I think that, you know, the center is moving toward a more neutral place, and that's sort of what markets are saying too. I just think, you know, there's a lot of signaling going on when you change guidance like that, and so we just, I guess a majority of us didn't feel like we needed to send a signal on that right now, but maybe it'll come to that, and the reason is because, you know, we're kind of waiting to see what happens with events in the Middle East and what are the implications of those events for the U.S. economy. So there's a group who feels like we don't need to be in a hurry to do that. We get it, and of course we will move to a hiking bias if we want to hike, and we'll move to a neutral bias before that. But there was a difference over whether to do it at this meeting, at a meeting at which all but one of us agreed that the rate decision was correct, which was not to move.
And you just said moments ago that you believe Fed independence is at risk. Is it safe to say that you want to stay on as a governor to serve as a check and balance on that?
I want to stay until I will stay until I feel it's appropriate for me to leave. And yes, that is really what is driving this. I'm not looking to be, a high-profile dissident or anything like that. I'm more looking at the other aspects of this and wanting to see that things have calmed down and we're returning to a traditional model of working with the people that you have and bringing them to consensus and respecting that consensus. That's what I'm hoping to see.
Matt
Egan. Thanks, Chair Powell. Matt Egan with CNN. You've made many tough decisions in your time at the Fed, and as your time as chair comes to a close, and you think about your tenure and perhaps your legacy, are there any decisions that stand out as ones that you're particularly proud of? And are there any that, with the benefit of hindsight, you would take a mulligan on?
Yeah, it's hard. I wouldn't want to single out individual things at this point. I'll just say, we, all of us together, have consistently tried to do what we think is best for the American people based on our tools and our objectives that Congress has given us. It's been very challenging because we've been in a situation of supply shocks really for 6 years. And that's just a very different situation than for a very long time. What the Fed and other central banks were doing all the time was demand management. And, and there was always the inflation mandate, but inflation was low for 25 years. So this is a very different world and a much more challenging one where you have to balance the two objectives. And by the way, central banks that have an inflation mandate have to do exactly the same thing because they're balancing economic activity. So that's been challenging, and we've tried to do our very best through these really challenging times, and I'm really proud of the work that I've done, that my colleagues and I have done during these years.
Now, to follow up on some of the discussion around Fed independence, can you explain to the public why this notion of Fed independence, which might sound kind of wonky to some, is so critical? I mean, what are the consequences if either the Supreme Court rules against Lisa Cook or the Fed in the future decides to make decisions more around the political calendar instead of the economic data?
So every major advanced economy in the world has made the same decision the United States has made, and that is that they want to take the making of monetary policy, the setting of interest rates to support the economy, to achieve maximum employment and price stability. They want to take that out of the direct control of elected politicians. And the reason is elected politicians are always running for election, and they'll always want low rates, and that will lead to inflation over time. So after literally centuries of experience with that, the whole world moved to the different model, and it's worked great. I mean, this is the era in which inflation was under control for 40 years. Then we had the pandemic, inflation everywhere in the world, and now we have inflation that had gone pretty much all the way back to target, really close to all the way back to target, and now is being buffeted by the energy shock, and the U.S. buffeted by the tariff shock as well. So, but what I would say to the general public is that's the backstory, is that don't think about it, an institution being independent. Think about it this way, that you want people to make monetary policy and set interest rates to benefit the general public and to try to achieve economic goals, which are maximum employment and price stability, and focus only on that and ignore political considerations completely. Ignore them. This isn't bipartisan. This is nonpartisan. So we want to just work directly for the American people doing these things. We don't think, oh, I want to do this because the president says it's a good idea, or because there's an election coming up and I want to speed up or slow down the economy. I mean, think about that. If that's what we were doing, we'd have no credibility. Markets would lose faith in us, and our ability to control inflation and have any respect would be gone. And let me say, whatever people say, the markets believe in that we will produce 2% inflation. If you look at longer run expectations, markets believe that there's no sense in which our credibility in the markets has weakened. It's just not the case. It's people do get it, that this is our commitment and that we will achieve it, and it's priced in. If you disagree with that, then you can go ahead and bet against the markets, but the markets are pricing in Fed credibility.
Okay, we'll go to Richard for the last question.
Thank you, Chair Powell. Richard Escobedo with CBS News. We've talked a lot about gasoline prices and even you mentioned airline ticket prices, both of which are up dramatically because of the war in Iran. And so I wonder, are you seeing that weigh down consumer spending in other parts of the economy? And if so, how worried are you that that will be a drag on growth?
You don't see it in spending yet. You really don't. I mean, as one of your colleagues said, the economy has been resilient. It really has. Not just this time, but it's been remarkably resilient for some years now. The U.S. economy has just powered through shock after shock, and consumers are still spending, and that's what the banks will tell you, credit card companies will tell you, the retail sales numbers that we got most recently. People are still spending, and how long can that go on in a world where if gas prices were to go up a bunch more, that's taking otherwise spendable money out of people's pockets. But right now, we don't actually see much slowdown yet, and certainly none from this. But you think logically you will, because people have a certain amount of money to spend. If they're spending 25% more on gas or something like that, then that's going to come out of other spending. But we don't see it yet.
One last thing. You mentioned those economies in Southeast Asia that are particularly dependent on petroleum. They make a lot of the stuff that American consumers buy. So was there any discussion today about whether or not those costs getting passed along to consumers is a real concern, and whether or not that might push up inflation?
So all of those things are in the models that we use to calculate inflation. So they're just parts. You can ask about anything like that, and they have a place. The staff has a place where they're looking at that and pricing in what will happen with higher prices and that kind of thing. So it's there. The effects are not that big yet. We're a huge economy. The import sector is only 10% of the economy, so we're not like a European country where 50% of the of GDP is in the external sector. We're also, as I mentioned, we're an oil exporter, so we're not feeling the same kind of pain, and we're not likely to feel the same kind of pain that economies in Western Europe and certainly in Asia are feeling. Anyway, thank you very much, everyone. I won't see you next time.
For the last time, the chairman of the Federal Reserve, Jay Powell, wrapping up a very interesting news conference at the Federal Reserve down in Washington, D.C. for the last time as the Fed chair, but that man is not going anywhere. The price action looks like this. Equities unchanged this afternoon on the S&P 500, which is quite impressive given this move in the commodity market. Brent crude very close to 120, higher for an 8th consecutive day, up by 7% on the session, and some significant notable moves in the bond market as well, particularly at the front end of the yield curve. Twos higher by 9 basis points at 392.63. In the next 20 minutes on this programme, we need to discuss two things. The future of Chairman Powell, 1, the easing bias at the Federal Reserve, 2, on the future of Chairman Powell staying on as a governor of the Federal Reserve. He was asked why. This is what he had to say.
My concern is really about the series of legal attacks on the Fed. These attacks are battering the institution and putting at risk the thing that really matters to the public, which is the ability to conduct monetary policy without taking into consideration political factors.
The Federal Reserve Chairman Jay Powell on independence. I think Fed independence is at risk. So what about the easing bias? Let's talk about monetary policy. A question coming into this decision is whether this Federal Reserve would move to a more symmetrical reaction function. That's the jargon. This is the plain speak. Is it just as likely they'll hike as they'll cut? They didn't do it this time around, but there was some dissent. This vote was 8-4, 4 dissents. Haven't seen that since the 1990s. Of those 4, 3 wanted to get rid of that easing bias. This is what the chairman had to say on that issue.
Number of people on the committee who either could support that language changing to a more neutral stance so that a hike is as likely as a cut. That number has increased over the intermeeting period, and it's easy to see why. We had the discussion. A majority are still on the page of not feeling the need to move to that level, and that's where I am. I get it, though. At a certain point, you would move, and that conceivably could come as soon as the next meeting.
They're getting closer, but they're not there yet. So much to learn, apparently, over the next 30 to 60 days.
I thought that was the most market-moving aspect of the news conference, the idea that it wasn't just the three dissenters who wanted to shift to a more neutral kind of positioning, symmetric kind of positioning, but that it was a bigger group that just didn't feel like there was a need to move right now, because ultimately, why move now when so much can change? Nonetheless, this goes on for as long as people might be thinking based on the oil prices in the future. This is something that clearly will come back on the table.
I like the way on the Bloomberg Professional Service we have a way to see the president's tweets quickly. I am waiting to see a presidential tweet. Do we get it by the time the clock turns around here, or do we get it by Meta's earnings here in X number of minutes?
Things have softened somewhat around this institution, just a little bit. We heard from the Treasury Secretary, Scott Bessent, who said it's understandable if this Fed remains on hold for some time. But the last thing we heard from the president was something like this: if the chairman doesn't leave on time, I'll fire him. Now, what does on time actually mean? Because he can stay on as the board of governors, he can stay on that board until 2028. Is that on time, or is the president looking for something else?
Are we entering a new standoff? We're dealing with a standoff in the Middle East. We were dealing with a staring contest between Tom Tillis and Donald Trump, and now we might be dealing with President Trump versus Jay Powell, the governor, to see who blinks first, who's going to drop the legal cases, who's going to step away. And this could potentially get pretty tense, especially if the bar is that much higher right now for Fed Chair Jay Powell.
Mike McKee was in that news conference. He'll join us in just a moment. I want to start with Jim Bianco of Bianco Research. Jim, welcome to the program, buddy. I think Fed independence is at risk, the chairman's words. I'll continue to serve as a governor for a period of time. Recent events have left me no choice but to stay. Your reaction, please.
I think it's one of the most disappointing things that he's done during his chairmanship. That is a political decision. The decision was made to push the investigation of the building to the Inspector General. The Inspector General finds some malfeasance or wrongdoing with the building, they'll have a criminal referral. That is appropriate. He seems to be saying that the Fed has billions of dollars in building construction and no one's allowed to ask any questions about it. And he's going to stand in the doorway and disrupt the Fed as long as they're going to look into this building. I think that that is a big, big disappointment. I would have expected more from him, to be very honest. And I'm a guy that liked him. I'm a guy that would have reappointed him. And I think this is a big disappointment that I've seen from him.
Jim, do you think that it has longer-term ramifications for the institution based on the fact that he is saying he does think that this is an independent institution, a committee, but does want to avoid some of the attacks that he says are battering the institution?
Mariner Eccles is the only other Fed chairman that stayed on in the late 1940s. And his memoirs say that he stayed on because he saw with Bretton Woods and with the World Bank and the IMF in the post-World War II period, change was coming, and he wanted to marshal the world through those changes. It seems like what Chairman Powell is saying is, we're 80 years later and change is coming, and I want to stand in the doorway and prevent those changes. He said that he wants to see a more traditional move back to the Fed. He wants to see the Fed institution remain the way it is and not evolve. Now, as far as independence goes, I think we've solved the independence problem with the vote today, 8-4. We have 12 independent voters. The chairman is one of those voters. That is how you're going to get a truly independent Fed. The chairman cannot dictate the policy like he has for the last 40 years. He needs 6 other people to agree with him in order to get that policy across. What's going to happen if we continue to have these dissents? I'll remind you, last year, the Bank of England had a 4-4-1 vote. If we get to a 6-6 vote with this Fed, we're already at 8-4. That gives Chairman Powell all the power to decide what the policy is going to be, even though he said he's not going to give any speeches and he's going to remain in the background. Or is he saying that he will just do whatever Chairman Walsh tells him to do, and that's the way he's going to vote, and he's not going to vote independently? So there's a big problem that he needs to define and try to explain, and he didn't at this press conference.
Jim, I look at this simplistically. I got oil at 119.61. And this announcement that I saw on the Bloomberg that we're leaving an aircraft carrier from the Middle East, the Gerald Ford with 5,400 sailors, I believe it is coming home exhausted. Is Jerome Powell simplistically in the same way just staying to block a Trump appointee, period?
I hope he's not, and I hope that, he's trying to be fair-minded in his decision, and I disagree with the decision, and we can have disagreements in it, and that isn't being as political as that he doesn't want Trump to have another appointee. And by the way, we'll get the Lisa Cook decision by June when the court adjourns. And if they do allow him to fire Lisa Cook for cause, I would assume probably the same day he'll fire Jay Powell. And we'll have to, and then he'll get 2 votes, or he'll get 2 open seats to be able to replace. Now, of course, the court could rule otherwise, but that's coming as well, too. But I hope it's not that. I hope that it is more that he has a view about the institution not changing in a world where I think we're changing and it needs to evolve, and he's preventing that.
Jim, stay close. I've got Mike McKee standing by. Just hopped out of the news conference. I want his reaction to all of this as well. Mike, you're in the room. Have you got a different perspective on things?
Yes, I think I do. I was listening to what Jim said. I don't think Jay Powell is staying because he's trying to stand in the way of progress at the Fed. I think Jay Powell is staying because he doesn't trust the Department of Justice. He noted at the top that the Justice Department had said that they were dropping the probe, but he referenced back to Jeanine Pirro's comment about we could file another criminal complaint. And he doesn't know what the Justice Department will do, whether or not there would be validity in what the Justice Department might do. So he wants to make sure that that is the case, and he will at least probably stay through the Inspector General's report. It is also possible he would stay on beyond that in order, as you did mention, that in order to deny the president the possibility of another seat if he thinks what the president wants to do is take political control of the Fed.
So, Jim, I want to give you a chance to respond to that. If anything, the chairman's been consistent. He set a bar. He said this needs to be wrapped up with transparency and finality. And based on the comments we've heard, according to the chairman, he thinks they've fallen short of that bar, Jim.
Yeah, I think he thinks that. Senator Tillis does not think that. That's why he voted today to advance his nomination. And I agree with Mike that he does not trust the Justice Department, but it's not his call. It's the Justice Department that the American public elected through the election of Donald Trump. And if he doesn't like it, he's going to then stay as a disruptive force to the Fed to prevent them from making any kind of changes or referrals or even looking in. Remember, this is all about the building cost and why it's been taken several years and is run so expensive. And it seems like he's saying we're not allowed to ask.
I got another disruptive force to talk about, Jim. Allow me to jump in. 120 on Brent. Just breached that level moments ago. Higher on the session by 8%. Let's just take a step back. The chairman's future is one part of the discussion. These market moves are something else at the moment. Brent at 120. Just sit on that. Yields higher at the front end of the curve, retesting the highs of the last 2 months or so. And equities. Bring up the equity screen at the moment. Equities this afternoon, in the face of these moves in fixed income, these moves in commodities, doing almost nothing, Bramo. Hardly moved, not even phased ahead of these earnings later this afternoon.
And this was what the Fed was talking about, right? We have the NASDAQ actually up 0.4% ahead of those earnings. As we look to the strength that Fed Chair Jay Powell was talking about at his last press conference, but this is where it becomes tricky. At what point do those higher oil prices that might be leaving big tech unfazed become an inflationary pressure that can be could be withstood simply because there is enough momentum in this economy?
Jim, let's get to the price action. Not so interested in shouldn't, interested in market consequences. Here's a Federal Reserve debating dropping its easing bias, pressure building in the commodity market, rates repricing, yields higher. What are the consequences, Jim?
I think the consequences are huge because if you look at the way that oil is trading, you're right, that the June contract went over 120 a few minutes ago, and that's the highest it's been since June of 22. What about the long term? Okay, let's look at the December contract. The December contract is making new all-time highs too. And it's saying to us, at least if you want to take it at face value, that the price of oil is going to stay elevated at least through the end of the year. As Chairman Powell said, we already have, he said, 3.5% on PCE inflation. That's their measure. And if it's all driven by energy, it's going to stay there right now. And it's going to be problematic for the Fed to even talk about an easing with that level of inflation. It's not going to disappear and go away unless there's some resolution in the war. And the problem is the market doesn't see the resolution in the war. That's why both the June all the way to the December contract continues to move higher.
Hey, Jim, good to see you. Appreciate your opinion. Jim Bianco there of Bianco Research. Mike, always good to see you, buddy. Great work in the news conference. Mike McKee down in Washington, D.C. If you're just joining us, welcome to the programme. We are set up for quite an afternoon now. In the next 60 minutes or so, we should hear from 4 of the biggest companies on the planet, Microsoft, Meta, Alphabet, Amazon. Before we get there, some big market moves to talk about. 8 consecutive days of higher crude prices. Brent crude through 120. Just briefly, we've taken out the highs of the year on a closing basis. If we close at these levels, 119.95. Look at that. WTI comfortably into triple digits. This move in the bond market off the back of it. Yields higher at the front end of the curve, up by 10 basis points. Not just about oil, also about this Federal Reserve. If you missed it, here's a summary. An 8-4 vote. Haven't seen that level of dissent since 1992. Of that 4, 3 hawkish dissents, a conversation about dropping the easing bias. They haven't got enough people on side just to do that just yet, but we're losing support for that easing bias at this Federal Reserve.
And potentially, if this conflict in the Middle East doesn't get resolved, then all of a sudden you will have a consensus to move to asymmetric risk. We have now priced out a rate cut for 2026 in the Fed funds futures. At what point do we start repricing in hikes? Because ultimately, this is an economy that can withstand oil prices at this level, rates at this level, and that was the word that we heard from the Federal Reserve.
Repricing here is hard because it's a war. Somebody mentioned there, it's a war. We forget we're in a war. And within that, I don't know what the unknown is tomorrow or out to June 17th. Nobody knows. We're just going to take in the data and take in the war news. And what I'm waiting for, John, is to take in the next marginal President Trump tweet.
The S&P 500 down by 0.1%. If you looked at that, it was a snoozy afternoon and nothing happened at this Federal Reserve meeting. That's just not the case. Jeffrey Rosenberg of BlackRock joins us now for more. Jeff, what's the bull case in the face of what's brewing elsewhere?
Well, you highlighted it well between trying to disconnect what's going on between oil prices and the committee meeting today and what we heard. And, I want to highlight, the thing that I found most interesting about Powell's comments were explaining I think the second main point and takeaway of the meeting, which is this theme of a divided committee that comes out of the 8-4 vote. And he framed it as a natural consequence of the conflict in the Fed's objectives between growth and inflation, which the $120 oil, is that point. And he got asked the question about pass-through. And this is, I think, what the markets are really struggling with is he basically made the point. It's all about the time of which the Straits of Hormuz remains closed. And no one knows what that will look like. So Jim just talked about the forward curve, December contract making its new highs, but it's significantly lower than the front end of the curve. So there's an expectation here that at some point that's opening up. We don't know what that is. And I think divided committee is likely to be the continuation because of this point that Powell highlighted, that when you're faced with the conflict of the dual objectives, that people are going to see that in different ways. Some are going to be arguing for the growth impact, some are going to be arguing for the inflation impact, and that might be the more expected outcome as opposed to what we've seen and the historical comparisons of this being, very unusual. Maybe get used to that being a little bit more usual.
Jeff, it seems like the conflict in the Middle East isn't necessarily that close to wrapping up. Maybe it is, and we just all are getting mixed signals. Do you think this market needs to price in a greater chance of a rate hike as the next move by the Federal Reserve?
Well, it's already done that. And to this discussion about the easing bias and the language, the market already took the easing bias out. It did that at the onset of the oil price impact from the Iran war. So I don't think that as a catalyst for sort of the next move. That's mostly, the Fed is a deliberative body, getting the right number of people willing. You heard Powell talk about that. They're slow to move that bias. The market is not, and it's moved the bias to easing out of the market pricing. So I don't think that's really the market event. The market event is really the uncertain, unknown question that he was asked. What's the pass-through from headline inflation to core inflation? You heard Warsh talk about it in terms of trimmed mean and not looking at core PCE as a measure. That's a very particular way of looking at the potential for pass-through. Will he get and move the rest of the committee onto that view? If so, that's a very dovish implication, and you bring the bias back in. But as Powell highlighted, we really just don't know, so you're going to have to see whether or not those pass-through of headline into core shows up, whether Warsh's more dovish interpretation shows up, and whether he can push the committee towards his direction. And that will bring the bias back into market pricing, but right now we're pricing it out.
Jeff, I got 8 questions and time for one, and it's just simple. For our listeners and our viewers across this nation and worldwide, what is the best tool to use in the bond market to study the potential dynamics? Don't, the benchmark 10-year or is there a unique Rosenberg spread that makes sense? What is the efficacious way to study the pulse is seen in fixed income?
Yeah, Tom, the kind of historical rule of thumb is if you want to keep it simple, it's about the 5-year maturity point on the Treasury curve. That's kind of impacts the best estimations of where you're looking for current and forward-looking Fed expectations, and that kind of is your benchmark for looking at. You can look a little bit shorter. 2-year is going to be the more near-term expectations. I think that's a really good metric. And then on the inflation side, remember inflation, headline inflation is going to impact shorter maturities. You want to look a little bit further out. You can look at the slope of the curve. 5-year forward measures on break-even inflation is better when looking at longer-term market expectations of the impact on inflation. And so far, that's been relatively benign. And so that's kind of supporting, Powell's comments in terms of market longer-term expectations not being unduly impacted. If you started to see that change, that's going to be a major signal for Fed policy pivoting more towards the inflation concern if you start to see that show up in that metric.
Jeff, last question from us. Last time we had yields at these levels, close to them, was the end of March. And every person we spoke to in fixed income on Wall Street had a very favourable interpretation of these moves. They said we were creating value and they wanted to buy it. Jeff, do you think we're creating value this afternoon, and do you want to buy?
Well, I think the move in the front end is creating some value. You're seeing a big curve flattening. Again, a lot of it is conditional on that pass-through of inflation, but stepping out of the curve into the front end, we're having Warsh come in. He's already signaled that he wants to look through that and take a more dovish interpretation. Will he be able to bring the committee along with him? When you start pricing hikes in, it depends on the oil move and it's persistent, but I think there's a little bit of value there. Completely different answer, really to the opposite side when you look in the long end of the curve. The long end needs to build term premium. We got a savings glut that's turning into a savings deficit, particularly as we need to reshore, rebuild, reallocate in global savings around the implications of this Iran war. All at the same time as fiscal deficits are increasing the demand for that borrowing. I think there you see a different story, and that's less of a buying opportunity and more of something we're going to need to see increase in terms of the term premium to bring investors back into the long end of the curve.
Hey, Jeff, good to see you. Great answer. Jeffrey Rosenberg there of BlackRock, breaking down his views, not because I think it's the right answer, just it's an important answer to a very difficult question right now. 2-year yields higher by 10 basis points, 10s at 441.
If you think that right now there's a great opportunity to buy in the 10-year, give us a call, because right now everyone who we ask seems to go right to the front end and saying that's where I'm going to get some yield. But right now on the long end, things might be changing. And ultimately, we just can't get ahead of it. And that seems to be a theme again and again.
Bob just emails in. He's on his way to F1 in Miami here. And Bob's looking at it and he's going, the price of gas went up 10 cents yesterday, 22 cents this week. People aren't eating out at restaurants. That's got a lot more to do with this than any of the fancy
That
talk.
flight got more expensive. This afternoon is not over. Big tech coming up after the close. Coming up tomorrow on Bloomberg TV, on Bloomberg Surveillance, we'll kick things off with Julian Emmanuel of Evercore. We'll catch up with Mike Wilson of Morgan Stanley and a whole lot more from New York City this afternoon. Good afternoon.